Hello friends, how are you? Jeremy Grantham is a long-term investment strategist and co-founder of GMO. GMO has roughly $65 billion under management. On 20th of January this month, 2022, Jeremy Grantham posted an article on GMO's website called "Let the Wild Rumpus Begin," approaching the end of the first U.S. bubble extravaganza, housing, equities, bonds and commodities. In this video I will go through this article and give you a summary of what was said in the article. I will as well say some comments of my own also here and there in this video, so if you're looking to have Grantham's view 100%, you need to go and check the article from the website. I will provide the link in the description box below. But as said in this video, some of the things will be summarized on base of Grantham's article, and some of things I'm gonna say are gonna be my views on the current situation in the stock market. So let's go. So let me first read you the executive summary of the article. It goes like this. All 2 sigma equity bubbles in developed countries have broken back to trend, but before they did, a handful went on to become super bubbles of 3 sigma or greater, in the US in 1929 and 2000, and in Japan in 1989. There were also super bubbles in housing in the US in 2006 and Japan in 1989. All 5 of these super bubbles corrected all the way back to trend with much greater and longer pain than average. Today in the US we are in the 4th super bubble of the last 100 years. Previous equity super bubbles had a series of distinct features that individually are rare and collectively are unique to these events. In each case, these shared characteristics have already occurred in this cycle. The checklist for a super bubble running through its phases is now complete, and the wild rumpus can begin at any time. So, where is the bubble then? It's everywhere. It's in interest rates that are super low, it's in stocks which valuations are super high, at least in the US. It's in commodities, which prices have gone up a great deal during the last year. And now it's also in housing prices, which has gone up. And bubbles are everywhere at the moment, and it's dangerous for the economy, dangerous for us investors. Let's take a little bit closer look of what I mean through great charts provided by tradingeconomics.com. Here on the screen you can see now the Standard & Poor's 500 United States Stock Market Index last 25 years, and as you can see we have the collapse of 2008 financial crisis right there in the middle, and after those times practically we've had the longest bull market ever seen in the history. And when you really take a look at the corona dip that is visible there in the year 2020, you can see that the prices of stocks have gone up with even accelerating pace compared to what it has been after the financial crisis. So that is how a bubble looks like when it's forming. Then on the next chart we can see the US 10-year note bond yield, which are the interest rates. Not a surprise probably to anyone following economics news that the interest rates are practically at the lowest point they have been for a very long time. Here you see the last 25 years. Next up we have the FHFA, which stands for Federal Housing Finance Agency House Price Index. Measures month-over-month changes in average prices of single-family houses with mortgages guaranteed by Fannie Mae and Freddie Mac. And as you can see, quite similarly as to the stocks chart, there is an accelerating pace of pricing of housing happening after 2020. Again, something that looks like a bubble forming there. Next up, let's have a look at some commodities. First one, we have crude oil here. As you can see, after dipping in the corona crisis, the price of crude oil has risen dramatically and continues to go upwards from, what is it, about $90 today. No idea yet where that will go. Nobody can predict the oil prices. Nevertheless, the direction is pretty clear and it is very rapidly going up. Next one, we can look at natural gas, EU Dutch. Natural gas through the roof, as you can see, after the corona started, and obviously this commodity has something to do with Russia, the situation with Russia and Ukraine for sure at the moment, but just illustrating you the prices of natural gas in Europe and how dramatically they have gone up during the recent times, and volatility is huge there. Very exciting times for natural gas, and as you know, I have Gazprom in my portfolio, so definitely I'm watching this commodity, this thing developing very closely. Next up, we have copper, used for example in electronic vehicles, very much also in very many other instances in healthcare sector, for example. And well, copper is very versatile metal and it has lots of uses. Nevertheless, when we take a look at copper prices here, they are in 25-year high, have been there already before once, but nevertheless, the highest copper prices in 25 years at the moment. We're having same story with the next chart, steel. As you can see, pretty similar stuff to the copper, but nevertheless, basically testing all-time, not all-time highs, but 25-year highs here. I'm sorry, actually, not that long, 10-year highs, let's say. Next chart, we can go to lumber. As you can see, there was huge increase a while ago in lumber prices, which has then come down drastically. This is also, as you can see in the US, the situation. It went up dramatically, then it came down dramatically, and yet again pretty much up. And what can you say? This is the same story as with earlier with natural gas. There is huge volatility in the prices, and where will this go next? Myself, I have no idea yet. Next up, next chart, we have aluminum. Same as what you have already seen here before. Aluminum prices in 25-year highs. Again, very versatile metal used in many applications. A very important metal with many uses in the world, so that's why I picked it here to show you. Next up, we can go to things we eat, or at least some of us eat. The price of beef in the UK. As you can see, last what is this? Well, almost 20 years or something. Chart, prices have gone up all the time, but as you can see, starting from the COVID era of the world, huge price increases in beef too. That is something we eat, and we will come to the food prices also later here, which have gone up very much. That is creating already, along with the inflation that is going on, the rise of food prices is creating pain for some people already in our daily lives. But let's check another food source. Next chart we have here is corn. As you can see, corn prices have during the last 25 years, they have been up a couple times, but again, they are testing those highest prices in 25 years, also been on the price levels before, but definitely above the trend line here. Next up, coffee. As you can see, same story as with corn, we have going on here with coffee. Prices climbing up all the time, and don't know how far those prices will climb up, but they are not too far away. Or, okay, they are a little bit far away from the 25-year highs, but definitely going to the 25-year highs, well above the trend line again. Then, again, as you can see, next chart, soybeans. The story seems to be similar to all these foodstuffs here. The charts look very similar, all of them going up and no end in sight, I would say. And how about the purchasing power of people, as these prices of food, prices of commodities rise all the time, and the end is not anywhere to be seen. Energy prices are increasing, gas prices are increasing, food prices are increasing. This is quite dramatic, and will affect the daily lives of many people for sure. Next up we have here is the Consumer Price Index, so let me just read you the description. In the United States, unadjusted Consumer Price Index for all urban consumers is based on the prices of a market basket of food, 14% of total weight, energy, 9.3%, commodities less food and energy commodities, 19.4%, and services less energy services, 57.3%. And this last category of 57.3% is divided by shelter, 32.1%, medical care services, 5.8%, and transportation services, 5.5%. And as we can see here in the chart, well, this is basically the cost of living chart. In the US, you have the trend line is pretty clear, where the prices have always been, but what has happened now after COVID, the prices have jumped up hugely due to inflation pressures, and the daily life, as said many times already in this video, is getting more expensive to us all here, and this is a trend that must be stopped at some point. With this level of rising prices, I do hope your employer is ready to lift your salary accordingly, otherwise you are getting poorer over time for sure, and this is a fact. Interest rates must go up in the US to control this before it hits hyperinflation, and the hell literally breaks loose here. As Warren Buffett says, interest rates work to stocks like gravity to matter. Interest rates go up, stocks go down. Growth tech is the first one taking the hit, and it has already took a roughly minus 50% hit. So obviously how to control the rising prices is to control the inflation, and inflation is controlled by hiring interest rates. And then when interest rates are lifted up, that is bad news for stocks, which become more expensive by their valuation are sure to go down accordingly when you lift interest rates up. So this people and stock market is already expecting this, and this has caused, for example, the rapid decline of Nasdaq and the growth tech stock sector, which has taken big hits, as said, minus 50% some stocks. So these all things are connected. And now back to the actual Grantham article again. Who will the super bubble territory hurt the most? It will hurt the most low-income people, as they have no chance to climb up to wealthier classes, because all of their money will go to gas, to food, and to pay the rent they have. No money to invest and acquire assets, which can lift one up in the wealth classes. No money for education either, which could help you to move upwards in the wealth classes of your nation. Big portion of low-income people are obviously young people and young adults, and they will be the most hurted of this situation. They will suffer terribly due to central banks and feds who have let this situation develop to the point we are today. That is the prediction Grantham is making, and I am also agreeing to. In this environment we are living, it has become evident that the rich are getting richer and the poor is getting poorer. Inequality has grown and will grow if this trend will continue. As said in the executive summary, the world has had 3 super bubbles before, and we are living the 4th today. The previous were US in 1929, US in 2000, and Japan in 1989. And now let me quote Grantham from the article. Previous equity super bubbles had a series of distinct features that individually are rare and collectively are unique to these events. In each case, these shared characteristics have already occurred in this cycle. So you can say that the checklist is done, and everything that needed to happen according to Grantham's theory has happened, and according to him the clock is now ticking and the boom might come any day here. The second to last event is super rapid growth in stock prices, which started already in 2020 and ended in 2021 February. The Nasdaq rose during this time 58%, measured from the end of 2019. Again, I quote Grantham, "The final feature of the great super bubbles has been a sustained narrowing of the market and unique underperformance of speculative stocks. for example, like the growth tech stocks, many of which fall as the blue chip market rises. Now, let's have a look at Warren Buffett's Berkshire Hathaway during the last year and compare it to Cathie Wood's ARK Innovation Management Fund, which concentrates mostly on these kind of tech sector stocks, high growth tech stocks. And let's see what has happened between those two. Here we have Berkshire Hathaway stock. As we can see, the last year it has only climbed up all the time. Berkshire Hathaway 1 year returns have been very, very excellent, 36.6%. Absolutely amazing return. Too big of a return, I would almost say. Too big of a return. Usually stocks do not go up this fast, and that's just a historical fact. But now, that was Warren Buffett and Berkshire Hathaway, and let's see how Cathie Wood ARK Innovation has been doing at the same time. And as we can see, the trend line is like the mirror picture of Berkshire Hathaway ARK Innovation Fund going down. It has gone down in 1 year minus 49.9%, so 50% of the highest valuation of the ARK fund has gone up in the air and doesn't exist anymore. So going back to what Grantham said, the escape from these kind of speculative stocks to blue chip stocks, which Berkshire Hathaway here represents, it has happened now already. So why does this phenomenon occur? Maybe because investing professionals know that speculative stocks are dangerously overpriced, and while they must own something in their portfolios for their clients, they elect to choose more acceptable, more blue chip companies to go down with these big household names rather than with stocks in the high growth tech sector. Eventually, Grantham though says that the reality will also catch the blue chip stocks, which will go down also after the high growth tech sector. Also, Grantham says that crazy things happen before these bubbles can burst, and have we seen crazy things happening lately throughout, let's say, last 2-3 years? I will just throw out some words here now, and you be the judge if we have seen some crazy things happening in the world of investing. We have meme stocks like GameStop, we have electronic vehicle related stocks and their valuations, we have cryptos, and we have NFTs. Have a look at those and you tell me if everything that is happening with the prices of these asset classes is normal. I would say definitely not normal at all. The longer the bubble goes on, the harder the pain will always be when it bursts eventually. Grantham throws an estimate that Standard & Poor's 500 should be around 2,500 worth today, and today it has been recently, the Standard & Poor's 500, in the range of 4,400 to 4,700, so very much overvalued according to Grantham. By the way, while I'm doing this video, why on earth, if someone watching this video has an answer, please do tell me. But here in Finland where I am, I don't know, the Netflix, when it shows me the most watched movies on the platform, I guess that's in Europe, or in Finland the most watched, I mean. Constantly throughout the last weeks I have seen The Big Short and Inside Job there as the most watched movies in Netflix, and I wonder why this is. Like, I know that Ryan Gosling and Steve Carell are great actors, and Matt Damon has a nice voice to narrate the Inside Job, and also a nice voice to speak in the Crypto.com commercial, by the way. Definitely great movies. One of my both of them, and especially The Big Short, my favorite movies of all time. But it raises a question in my mind: why are people watching these movies now? They're old movies. They didn't come out last year, so what might be a reason for that, I wonder? So where are we today? Let me again quote Grantham from the article. "We are in what I think of as the vampire phase of the bull market, where you throw everything you have at it. You stab it with COVID, you shoot it with the end of quantitative easing and the promise of higher rates, and you poison it with unexpected inflation, which has always killed PE ratios before, but quite uniquely, not this time yet, and still the creature flies, just as it staggered through the second half of 2007 as its mortgage and other financial wounds increased one by one. Until just as you are beginning to think that the thing is completely immortal, it finally, and perhaps a little anticlimactically, keels over and dies. The sooner the better for everyone. So there you have it. There you have Grantham's prediction on what he thinks will happen with the stock market we are having today. And finally then, what does Grantham and GMO suggest us to do now that the vampire is still standing in front of us, as handsome as well as Robert Pattinson in the Twilight movies, as Edward Cullen still? What do we do with the vampire when it's still alive? GMO has a detailed set of recommendations available that I agree with. So Jeremy Grantham agrees with, not Christian Niemi right here. A summary might be to avoid US equities and emphasize the value stocks of emerging markets and several cheaper developed countries, most notably Japan. Speaking personally, so Grantham speaking personally, I also like some cash for flexibility, some resources for inflation protection, as well as little gold and silver. And what has Christian Niemi then done in his portfolio right here on Arctic Money Channel? Well, for that you need to check my next video where I will present the current state of my portfolio and what moves I have made there when the vampire hunt is still ongoing here. When the vampire dies, things turn wild and some great opportunities will present themselves. Or then Jeremy Grantham and Christian believing Grantham here are just wrong and we have believed in false theories. I don't know, it might be true, but I like to do my investing so that you're prepared for anything to happen. And the aim is to try to make good money once things go your way. And when things don't go your way, the aim is to lose as little money as possible. And that's what I'm planning to do. And that's what I hope I have done with my portfolio, which I will present to you in the next video. So check that one out, coming soon. And see you in that video again. Christian out.